Hey there, how about becoming something more than just a skilled trader who knows how to make gains? It's about time we started building a historical reference base for your market knowledge. Keep watching, the new vision is incoming. This video will be the first one where we look into the economic past. So we need your feedback. Share your impressions and suggestions in the comments. And likes and new subscribers, I appreciate it as always. Alright, let's get into it. What economic event of the 20th century boggles many minds to this day and leaves us pretty anxious about how big a crisis can get? The Great Depression of 1929-1933. For most Americans, it's probably the biggest economic collapse in history. What caused it? What were the consequences? And what can we learn from it today? Let's take a look. The second decade of the 20th century in the United States was a jolly good time. Those years are often called the Roaring Twenties. Personally, I call them the double B decade because the economy was booming and blooming almost everywhere. Or so it seemed. But we'll get back to that just in a minute. Now, let's just imagine for a second. The Great War is over. The economy is prospering. The future looks bright and promising. Money is coming from everywhere. So what's the best thing to do? Get more money. That's what almost everyone was doing back then in the States. Banks were granting loans left and right. Individuals and companies were using those loans to invest and speculate on stocks, then use the profits to reinvest and speculate further. So the stock market was pumped full of cash in hopes of infinite growth. That was like a delusional, crazy fever dream that lasted almost a decade. In 1929, things were still looking pretty good. It wasn't an unstoppable frenzy like it had been until then, but there was little reason to suspect that something big was about to happen. With the exception of a minor crash in March that year, the stock market was more or less in the green. Then came a Thursday that started just like any other Thursday. Workers had their bacon and eggs and went to factories, bankers were sipping coffee and reviewing reports, and everyone was just looking forward to the coming weekend. Then the opening bell rang at the market. And boom, it instantly crashed a whopping 11%. Shocking, terrifying, a temporary collapse maybe. Everyone rushed to try to mitigate the situation and nothing had any effect. Bad luck, bad week. Then the next Monday, 12% came right off. Panic, horror. Then Tuesday, 11% further into the red. A complete devastation. Just to help you picture the scope of this calamity, between 1930 and 1933, more than 9,000 US banks failed, and the US stock market lost more than 80% of its entire value. People lost jobs, investors lost money, and the price of many stocks went all the way down to zero. It was, to put it mildly, pretty bad. While there is still some debate about the causes of this catastrophe, weak consumer demand, overheated stock price speculation, agricultural problems, and loose banking policies are often mentioned as the main factors fueling the crisis. On top of that, many economists believe that the initial efforts to alleviate the situation only exacerbated the problem. The US government tried to protect domestic industries by blocking foreign trade through higher tariffs. It didn't work. In fact, it seems to have made things worse. In any case, international trade in 1930 was already in bad shape, so that factor wasn't that important. On the other hand, the gold standard that backed most currencies back then now appeared to be causing problems rather than supporting economies. So it had to be undone. After the abolition of the gold standard, the turning point didn't take long to come. And although the unemployment rate was still at a dreadful 25% in 1933, that year is believed to mark the beginning of recovery. There is no consensus among economists about the recovery drivers. Some say Roosevelt's New Deal helped a lot. Others say restricting banks and fixing prices was useful. Many say that gold inflows from abroad helped the US economy. Monetarists and Keynesians still argue about this. But what we know for sure is that by the end of that unhappy decade, the crisis was over. What lessons can we learn from the Great Depression? 1. Don't let hunger for profit cloud your judgment. Stay calm, sober, and sharp. These psychology tips will help you. 2. Do your homework and study the assets you invest in. This video will tell you which stocks are best to buy in 2026. And 3. No matter what, don't lose faith. Even the worst of crises end eventually.
Olymptrade. Care that counts.